Most beginners make investing way more confusing than it needs to be. Before you buy your first stock, ETF, index fund, or crypto coin, there are 5 basic things you need to understand. Because once these 5 things click, investing starts to feel a lot less scary. Welcome to Investing from Zero, where we explain investing in simple language for people starting from scratch. In this video, you'll learn what investing actually is, why saving alone may not be enough, the difference between stocks, ETFs, and index funds, how risk works, and the simple beginner path to getting started. This is not financial advice. This is beginner education so you can understand the basics before making your own decisions. Investing simply means putting your money into something that has the potential to grow over time. That could be a business, a stock, a fund, real estate, or another type of asset. When you buy a stock, you are buying a small piece of a company. When you buy a fund, like an ETF or index fund, you may be buying tiny pieces of many companies at the same time. The goal is not just to store your money. The goal is to own something that may become more valuable, produce income, or grow as the economy grows. That is the basic idea. Investing is not magic. It is not supposed to be gambling. And it is not about guessing which stock will explode next week. At its best, investing is about using time, ownership, and consistency to build wealth slowly. Saving and investing are not the same thing. Saving is usually for safety and short-term needs. For example, money in a savings account can be useful for emergencies, rent, bills, car repairs, or anything you may need soon. Investing is usually for longer-term goals. That could mean retirement, financial freedom, buying a home in the future, or building wealth over many years. The important thing is this: money you need soon usually should not be invested in risky assets. Why? Because investments can go down. The stock market does not move in a straight line. It can rise, fall, crash, recover, and move sideways. So if you need your money next month, next semester, or maybe even next year, investing it could be dangerous. But if your timeline is long, investing can give your money more opportunity to grow than just sitting in cash. So the beginner rule is simple. Use savings for short-term safety. Use investing for long-term growth. Now let's make 3 common terms simple. First, stocks. A stock is ownership in one company. If you buy a share of a company, your results depend on what happens to that company and how investors value it. That can create opportunity, but it also creates risk. If that company struggles, your investment can lose value. Second, ETFs. ETF stands for Exchange Traded Fund. That sounds complicated, but the idea is simple. An ETF is like a basket of investments that trades on the stock market. Instead of buying one company, you can buy one ETF that holds many companies. For example, some ETFs hold hundreds of companies. This can make ETFs attractive for beginners because they can give you diversification. Third, index funds. An index fund is designed to track a market index. For example, an S&P 500 index fund tries to track the performance of around 500 large US companies. Instead of trying to pick the one best company, an index fund lets you invest in a broad group of companies. This is why many beginners hear about index funds and ETFs so often. They are simple, diversified, and easier to understand than trying to pick individual stocks. Here's the simple version. A stock is one company, an ETF is a basket, an index fund follows a market index, and for many beginners, diversification is one of the most important ideas to learn early. Every investment has risk. That does not mean investing is bad. It means you need to understand what can go wrong before you put money in. Risk can show up in different ways. A stock can fall because the company performs poorly. A fund can fall because the whole market drops. An investment can grow slowly. You can panic and sell at the wrong time. You can buy something you do not understand. For beginners, one of the biggest risks is not the market itself. It is emotion. People often buy when everyone is excited, then sell when everyone is scared. That is how many beginners lose money. They do not lose because they are unintelligent. They lose because they do not have a plan. So before investing, ask yourself, do I understand what I am buying? Can I handle seeing it go down? Do I have a long enough timeline? Am I investing or am I gambling? Those questions matter. Because a simple investment plan you understand is usually better than a complicated strategy you cannot stick with. So what is a simple beginner path? Step 1, build basic financial stability. This means having money set aside for emergencies before taking unnecessary risk. Step 2, learn the basics. Understand stocks, ETFs, index funds, compound interest, risk, and investment accounts. Step 3, choose the right type of account. Some beginners use a brokerage account. Others use retirement accounts like a Roth IRA or 401k, depending on their situation. The account matters because taxes, access, and rules can be different. Step 4, choose diversified investments. Many beginners start by learning about broad ETFs or index funds because they can spread money across many companies. Step 5, Invest consistently. You do not need to perfectly time the market. Many long-term investors use a strategy called dollar cost averaging, which means investing a set amount regularly over time. This could be every week, every 2 weeks, or every month. The goal is not perfection. The goal is consistency. Here is the big idea. You do not need to be rich to start learning about investing. You do not need to predict the market. You do not need to find the next hot stock. And you definitely do not need to understand every finance term before you begin learning. You need a simple foundation. Understand what investing is. Know the difference between saving and investing. Learn how stocks, ETFs, and index funds work. Respect risk. And build a plan you can actually stick with. That is how you go from zero to confident. If you are starting from scratch, subscribe to Investing from Zero. This channel will help you learn investing one simple step at a time. In the next video, we will explain ETFs for beginners and why they are one of the most common starting points for new investors.